the US futures have already pared their early losses. It's a negative open still expected amid the global sell-off, but let's chat a little bit more about this. We've got Lambregts joining us from Rabobank. Jan, hi, morning to you and afternoon from us. Jan, what's going on? I mean, how long is this sell-off going to last? As I see on my screen, US futures have rebounded quite a fair bit, but it seems like it's going to be yet again a negative start because Europe is having a rough day.
Yes, hi, good afternoon to you. I think we take our pick, of course, in terms of how many reasons we can find for this sell-off that are actually fundamental. You could say that inflation expectations, fueled by higher wage increases there in the U.S., the surge in U.S. yields, are all helping to make the discount rate higher for the dividend flows in the U.S. Couple that with, of course, a lot of short volatility strategies that are being unwound for people trying to benefit from that low volatility in the late cycle and now getting burned. And you have a whole story to fuel a market meltdown. Now, we have to see that in perspective, though. We had an unprecedented bull market. We've just erased the January gains and a little bit of the December gains. Fundamentally, the economy is still very strong. I mean, as evidenced by the labor report, as evidenced by the non-manufacturing PMI there yesterday from the U.S. And, of course, we still have a lot of the impact from the tax cuts coming through. And, yes, the Fed will hike, but they will only hike so much as the markets can bear. They've been making very clear to us. I think what spooked people a lot yesterday was the sort of flood of sell orders there an hour before close in New York, and the feeling that had a lot to do, like the flash crash in 2010 with machine trading, and people not quite sure, not quite getting their finger around it, and afraid that could have more legs.
Yeah, and purely, again, I would imagine that would be technically driven, like you said, a lot of it led by ETF selling because, look, inflation has not started to rise just as yet in the U.S. Rates, the Fed has not indicated that they're going to move more than thrice. Their outlook remains the same. You're not really seeing the growth numbers come in to levels which we saw in the peak of the economic cycle in 2004, 2005. So it seems like there's a lot of conjecture that the market is latching on to looking for reasons to sell off, and perhaps these are just worries that are getting accentuated on the downside. So my question to you is, how much more to go to your mind? Is 10% to the bottom or closer to 13, 15% is when we'll find the road to a recovery?
No, I think the big question in my mind is is this the start of a new bear market in stocks? And I think it's not. Right, it's just not the timing for that. Fundamentally, like you pointed out, the global economy, the business cycle is just in too good a shape at this moment. We still have 1 or 2 years to run on that probably. Now, having said that, we have had an unprecedented bull market, of course, and that makes us vulnerable to the corrections. And what makes us particularly vulnerable is the increase of passive investment strategies over active investment strategies, of the short volatility trades, of the ETFs, like you mentioned. And that is, again, where markets got a bit spooked and where we have a risk of, the leg down being a bit more aggressive than what we've seen so far, even though we've already seen quite a bit. But I'm longer term, or say the upcoming months, not pessimistic at the moment because I just feel this is not the time there yet. I just think it's hard to call the bottom at this stage for the simple reason we've had such an immense run up.
Thanks, Jan, for joining us and sharing your insights about what led to this mayhem and view going forward. That was Jan talking about machine trading led to substantial fall, not anticipating stability to sink in anytime soon.